Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Brian Joyce. He's the managing director on Nasdaq's market intelligence desk with our midday update. And Brian, stocks just see no end to this momentum. The Nasdaq 100 hitting another intraday high along with the other major averages.
Yeah, we are certainly in a bull market. We've overcome a lot of hurdles, a lot of uncertainty. The trade deal, we haven't inked anything yet, but there's a lot of optimism there. So, markets have just been rolling even before that. But into the new year, the Santa Claus rally has kicked in, and everything's doing. Most sectors, I should say, are doing quite well.
All right, and the obvious question is, will 2020 look like 2019? And we're looking at the reflation trade here. Let's bring up our first chart. You've been covering this for the past week. The 10-year Treasury yield, getting some clues there.
Yeah, so it's still setting up real nicely here. We have that clearly defined resistance in place now for about 3 months in the 190 to 195% range. The round number 2, which now lines up with the 200-day moving average, which is just a couple of bips above that 202, 203, could also serve as a resistance level. But overall, the rising trend of 3 or 4 months of higher lows going into that horizontal resistance, we know there's going to be a breakout up or down sooner or later. The longer-term trend has been to the downside, but these recent lows in in August and September coincide with the lows from 2016 and 2012. It's a major support level. My bias is that level does hold. We get the upside breakout, which would reaffirm the reflation trade. Generally, that's good for things like industrials, financials, materials, things of that nature.
Yeah, it's pretty incredible to watch what the financials have been doing as of late, considering it's not technically the best environment for them. So even if we get a little bit of movement within macro data, that could really send them over for next year.
Absolutely. And what's interesting now is that, with the Fed now locked down on the short end of the curve, if we look at the spread between the 10-year and the 2-year.
And that's our next chart. Let's take a look at that.
Yeah, so this is the 10-year, 2-year spread. You can see the multi-years from 2016 highs all the way down to the lows made just a couple months ago in September. About a 3-year downtrend. Well, we've been kind of in this sideways now consolidation mode, and just today and yesterday we're beginning to make a new year-to-date high in the spread between the 10-year and the 2-year Treasury that so many people look to as a gauge on the economy, which is also a good barometer for banks and their net interest margin. So if we do get that upside breakout in the long 10-year yield, the German bund, by the way, has a very similar, almost identical trade setup. We should see a widening of the curve, and that would certainly be a positive, I think.
All right, our last chart, consumer discretionary, and clearly the theme for 2019 has been the strength in the consumer.
Right, and what's interesting is when we had the rebound after the August lows, the August declines hit all sectors, especially the cyclicals. The rebound in September and up until now has really been, technology resumed its leadership role, but we did see the financials rally. Healthcare finally kicked in as well, but discretionary hasn't been joining that rally at all. It's been in a 5-month consolidation range, and that changed last week, and this week it's seen that upside confirmation from last week's breakout. So I like this space as well going ahead, and to me, just all things combined is a good setup. What I think will be another good year in 2020.
Yeah, I mean the S&P is up almost 30% for 2019, and you think if these things can confluence and come together, we could have another perhaps double-digit gain for 2020.
Right, but if you zoom out a little bit, you look at what's going on over the last 2 years. Materials are still below its January 18 highs by about 5%. Industrials are essentially flat. Financials just last week are breaking above its 2018 highs. So over the last 12 months, things are up 25, 30%. But over the last 2 years, a number of groups are essentially flat. So from a technical point of view, you could say they're just beginning to make their move.
Imagine if you get some energy participation, that would even provide some more of a boost. Brian, thank you as always for joining me at MarketSite. Thank you for joining me on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.